This week I missed out on an extra $2,000 from not risk managing properly in profit and maximizing my profits. Risk management is such a simple topic, but at the same time drastically complex because emotions are involved, because money is involved, because skill is involved. And when all of those things come together, if you're not managing risk at the core, you're gonna lose money in this game. And people who skip this video are gonna probably struggle down the line. So if that sounds interesting, I definitely advise you to watch this full video here, because we're gonna cover risk management from A to Z and give you a full breakdown of how to preserve money, how to grow capital with risk management, and most importantly, what is risk management as a whole. So this is gonna be a super important video. So definitely do the YouTube business, leave a like, subscribe, all of those good stuff. Hate to ask for it, but part of the game. So with that being said, let's get straight into video. I'm gonna catch you guys in the video and let's cover risk management here. So before we get started, the number one thing about risk management is if you're a beginner trader, even an advanced trader, you need to have a budget. Companies use budgets. Why shouldn't we use it as traders? We're trading like a business, right? Because our goal is to make money and we have to treat it like a business. We have to have proper operations, proper protocols, and proper management, right? So when it comes to risk management, there are obviously a few basic parts about risk management, which is known as lot size, calculating pips and points. So as we know, the markets move in something called pips, P-I-P-S / points, right? If you're a futures trader, then you're going to be using probably points. If you're a Forex trader and also trading, we can calculate in pips as well. Now, relative to that is going to be what? Is going to be your lot size, right? Lot size / contract size. So I'm going to say this in case people trade futures or trade something with contract. So for lot size, you have to be calculating that against pips. You can also calculate it against points, but mostly lot size is going to be calculated against pips. Contract size most likely calculated around points because contracts and points go together. So the main thing to save you time instead of learning is to make a Google search on how lots are calculated against pips, all right? But I'm not going to go into the calculations because it's going to confuse you. But normally, if a one-to-one basis, one lot is equal to 10 USD per pip. So if you have a stop loss, right? Because whenever you take a trade, basic risk management, you need to have stop loss, entry, TP, right? Set. That's your main thing. You have to have your stop loss, entry, TP. Never trade without a stop loss. Even if you're at the charts, keep a stop loss. You don't know what random candle can come, right? So if your stop loss is 10 pips, right? And we know that and you're opening a one lot, and we know that it is per pip $10, that means your stop loss at 10 pips is going to equal 100 USD. So you'll be risking 100 USD on this trade here. Reason being is that one lot, right? If you open a one lot here, right? So is going to equal 10 USD per pip, and the stop loss size is 10 pips. So you're going to be risking 100 USD on this trade here. So you need to be calculating that before taking trades, which is why you have to have a plan before taking a trade so you can calculate your lot size. Now, fortunate news is you don't have to calculate that. But just as an example, let's say I wanted to risk $50 on a 10 pip stop loss. That means that, again, I would use a 0.5 lot. Why would I use 0.5 lot? Because that would equal $5 per pip, right? But let me make your life very easy and you can start experimenting this by yourself. Just go online, search lot size calculator, and then just input it. The pair you're using, input how big the stop loss and start seeing the amounts. But you have to be doing this. A second thing you can do is be using a trade manager. Now, all of that stuff out of the way, that's more of the calculation side of risk management. And the main point I'm trying to prove here is that you have to be calculating that before taking trades. Know how much you're going to risk. Now, it has to be a percentage of your account. Just because you have a $100 account doesn't mean you risk $50 per trade, right? Don't be doing that. That's extremely silly. Okay, that's 50% of your account. You're going to blow it like this. So that's a little bit about lot size, contract size, all of that stuff. Now, when it comes to risk management, half of the reason you're losing in trading is you're over trading. Your goal is not to take as many trades as possible. Your goal is to take quality trades. I see so many traders get burnt out. They do well, profitable, boom, lose it within 1 week, lose all of their profits and are back to square one. So how much of our account should we be risking? 50%, 20%? No. You should really be risking, I would say 1 to 2%. And if you're funded, you should be just risking 1%. Because 2%, you lose 4 trades, that's already 6% down. You already passed 50% of max drawdown limit already. So now, if your account, okay, if your account is already in profits, let's say, okay, now you can start risking 1%, continue with the 1%. But once you come back to break even and start to dip down, the fact that you came from an account that was in profits, and this is the break-even point down here, and now it started to come back into break-even, that downward swing is going to knock your confidence because you lost all the profits you originally made. Not only is it going to knock your confidence, you need to start managing risk from now. Go down to 0.5% risk. Don't let the account drip into drawdown. Avoid that, right? So that's how you can manage risk as the account comes down and fix what's happened. Has the market dynamics changed? Is my trading psychology off? And once you fix that, you're going to hover maybe here, but then you're going to be back up, you get back to the 1%, etc. Right? And this is going to keep you from dripping into that drawdown. And then again, boom, you're in drawdown, your psychology is bad, you're not making money, you're losing money, you saved yourself there, right? Even when you start a new account, if you're not that confident yet, risk 0.5% on the new account till you have 1 to 2% profits to play with, and then go risk the 1-2%. Obviously, you could lose that in 2 trades. It's possible, but hopefully with a profitable plan, you shouldn't. But then you know what to do if you're coming back to that break even. It's that cycle until you get and you're playing with house money. Once you're playing with house money, confidence will be there, but don't get cocky, right? So the next step I want to get into, on basic risk management here is it's really as simple as that. It's simple as not over trading. It's simple as calculating your risk before taking a trade. It's as simple as not doing anything emotional. It's as simple, I gave you a few tips on how to navigate if your account comes back into drawdown. But realistically, once you become a profitable trader, you're starting to look at managing trades in profit. That's where it really becomes interesting. This is where the money is made. This is the most important part of the trade, is when the trade's in profit. So when it comes to managing a trade in profit, you should have set rules of when you go to break even, okay? Make sure that when you're going to break even, there's a reason you went to break even, not just because, I've been sitting in drawdown for 2 hours, I'm going to break even because I don't want to lose this trade. The second thing here is that, the way I do it personally for break even levels is I have targets in my trade. So I tell myself, okay, my entry is here, my stop loss is here, okay? My SL is here. Now, if I have a 4-hour resistance right here, but this is not enough to close because maybe this is 8 pips away. My stop loss is 15 pips. My TP1 is 15 pips for the 1-to-1, right? And that 15 pips is the 15-minute range here, okay? This is my 15-minute resistance. That's my main target. I'm looking to get here. But I have a 4-hour resistance in the way that I have to worry about. But it's not going to put me off my trade because I have 8 pips to there. So I take the trade. Once price taps that 4-hour resistance, okay, that is where I'm going to look to move my stop loss to break even, because that's a 4-hour resistance. There's no reason for price. The whole reason I'm targeting my 15-minute range is I expect volume to push through, right? Because if, let's say, we're in an uptrend, we expect price to break highs and respect lows. So I expect it to break through that 4-hour resistance. But I'm not going to marry my trade and say it has to because I'm in. I'm going to say technically it could reject that and make me lose. We could reverse from there. There's a probability of that. So what I'm going to do is manage risk, move my stop loss to entry, okay? That way, that if it comes down, taps me out at break even, I'm fine. And probability wise, because you can't predict, even if it goes to TP after, based on probabilities, I should be moving to break even at a 4-hour resistance. So that's how I manage risk. Now, if volume comes in and it pushes through, boom, TP1 is hit. Now, how do you know where to close at TP1? Because now it hit TP1, you're like, this should go to TP2, TP3. Again, have a plan. Does it make sense on high time frame? You should check out my video of take profit levels. That's going to exactly explain how you're going to take profit, right? That's a different story. That's about take profit levels. But as managing risk, that's how you're going to do it. Now, a second way you can manage risk is if you trust the trade, but it's not looking good, volume has died down, and you still want to remain in the trade, you can just, if trade comes back to entry, what you can do here is you can simply just manage your trade by closing half at entry. Because what you do is you reduce risk and say, listen, probability wise, we should have had a push, but I'm not going to be scared of my trade and get out and not trust my idea. I'm just going to reduce risk so that if I lose a trade because I'm not comfortable in it, I will lose less. And if I win this, I will learn and build confidence and still make money. Like how do you lose there? You've managed risk, and at the same time, you're going to still make money if you win the trade, right? But if you lose, it's not going to be detrimental. And both ways, you learn. So it's going to be very, 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 very key here. So that's a little video about risk management here. It's not a very complicated topic, but I hope the tips inside here are going to help you, learn a little bit about risk management, start to implement it, start to really take that seriously. With that being said, take care, trade sharp, and hopefully catch you guys very, very soon. Peace.